Here again with Smart System. In our last lesson, we looked at the two most popular moving averages, the exponential moving average and the simple moving average. In today's lesson, we're going to look at the 3 most common ways that traders use moving averages. As we learned in last lesson, moving averages are lagging indicators, which means they tend to work well in identifying and following a trend, but not to work well in ranging or trendless markets. Because of this, traders will often use them to trade with a trend, as well as to identify potential areas of support or resistance which may result in a continuation or reversal of a trend. So let's look at some examples. The most basic way that traders will use moving averages is to identify and then trade with a particular trend, or with the trend in a particular financial instrument. So here we have a chart of Goldman Sachs. Here's a 50-day moving average plotted on this. And you can see here that this 50-day moving average was pretty good at calling some very nice runs in the market or for the stock. The break above you caught a nice run up by trading on the break above that 50-period moving average. Then there was a little bit of a whipsaw there, where you about broke even, selling when it crossed below, and then buying when it broke back across. But then you caught a nice run up after that by buying when it broke back above. And then a really nice run back down by selling when it broke back below. Before the market moved into this choppy period or range bound period, you can see the strategy stops working there. And that's probably not going to be a strategy that you're going to use by itself, but in combination with some of the things that we've learned in the past, and some of the things that we're going to learn in future lessons. It's a nice complement to some of those things. Moving averages is support and resistance. A lot of times, particularly the more popular moving averages, the 50, the 100 and the 200-day moving averages, will establish themselves as support or resistance. They've done here on the chart Merrill Lynch, and simply by the fact that the stock has come down and touched this 100-day moving average so many times, a lot of traders gonna start following that moving average, and if it does break below, that's probably gonna be seen as significant in your level to see a nice sell-off as a result of the break there. So you can see how many times it touched the moving average there. If, and you know, just like with the other support resistance lessons, if the line would have been above, then you know that would have been a resistance line instead of a support line. Moving average crossover. So plotting a longer term moving average on a chart with a shorter term moving average. In this case I've got a 10-day, which is the black line, and a 5-day moving average, which is the blue line. And then the strategy here is to trade when the shorter period of the 5-day, in this case, crosses below, and when it crosses above you buy. Again here, not something you're probably gonna wanna use by itself, but in conjunction with some of the other things that we've learned and some of the things that we're gonna learn in the future. It might be a nice complement to that. So you can see here, you got whipsawed a little bit there on the cross, but then you caught a nice little run down before catching a nice run back up. Their chart of the euro dollar here, it got whipsawed again a little bit, but then caught another nice run up, and then caught a nice run back down. So you made some good money trading with just those 2 indicators. And obviously, you know, this was done in hindsight, and hindsight is 20/20. But you can see, for example purposes, how this would work. So that's our lesson for today. Again, with strategies and some of the stuff that we're looking at now. Remember that trading is risky, and you should only trade with risk capital. And this is just overview lessons and not meant to be trading advice or anything like that. So just keep that in mind, and make sure you do your homework before you enter any trades and those types of things. In our next lesson, we're gonna go over an indicator which is known as the moving average convergence, divergence, or MACD. So we hope to see you for that lesson. As always, if you have any questions or comments, please feel free to leave them in the comment section. Have a great day.